Okay, so we're going to work on our Chapter 16, accounting for taxable income. We're accounting for taxes. We're going to start our spreadsheet. So basically what I've done, I've just written all of this out in advance so it doesn't take so very long to do. Hopefully everybody's read the problem. So what we'll begin doing is just simply enter in information into our spreadsheet so that we can create our journal entries. So for 2013, they had $100 million income. It was 120 for 14, 140 for 15, and 125 for 16. We had installment sale accounting income of 55 million, 60 million, 50 million, and 75 million for 2016. I do want to go over and do a little side worksheet just to calculate the payments. So we're going to just put the years here and do this so you can see it if I can get my spreadsheet to work right. Okay, so I think it's 30, yeah, okay. And here I'm just going to put how much the installments were for each year, and the payments. Here, I'm just going to do a little formula here. It was 40% for the first year. For the second year, it was 25%. The third year was 20%, and the fourth year was 15%. And then I'm going to take this, if it'll let me. I'm just going to drag this through it all. Now, for 2014, the first payment is not going to be due until 2015, and then 2015 will be due in 16, and the 2016 will be due in 17. So here we have each of the 4 years. So you want to make sure that it adds up. And it does. And we also want to make sure that our payments add up as well. $240 million. So now we have our payments for each year. This is actually the taxable amount. Okay, so what you've done, you've just gone and calculated your payments in advance. So now you can just put them into your spreadsheet. So we'll just go back to our income spreadsheet, and we'll actually put what we need to pay over time. So in 2014, we had taxable was 22 million, 37.75, 46, 60, 75, 47, 75, 22, and 25. We're not actually doing journal entries all the way to 2020, but I just wanted you to see what we needed to put in there. Now, for depreciation from the income statement, they had $325 million in capital assets that we need to depreciate over 4 years. So we're going to actually start in 2013 because they will fully depreciate a full year. Normally, we do not prorate based on when an item is purchased. We do it at the end of the year, which is why we're doing it in 2013. So it was 325 straight line for 4 years. So it'd be 8125 per year for 4 years. Okay. The makers depreciation, which we need to put next, and I put the actual taxing increments of makers in your problem, so that you won't have a complete shock when you see that makers is not, 30% or 20%. These are the actual percentages from the Internal Revenue Service, and you can go to irs.gov to get those. Just go to just search for makers depreciation schedule, and I think is publication 46, I think. So anyway, the first year would be 33.3%, so we'll just take the 325 and multiply it by 33 to get the first year, and then the second year would be 44.45%. I might want to put a decimal there, it might help. And then the next year is 14.81%. And the following, the last year is 0.741%. Okay, so there's our makers there. And we have to net these, so we might as well set the spreadsheet up where it actually works. So now we have the warranty expense. So according to the problem, they had two warranty expenses, one in 2013 of $50 million and one in 2014 of $70 million. And they are accounting for these respectively, which were paid at 50% in each of the following 2 years. So for 2014, we're going to have 25 million for the first year, and then the second year we're going to have the 25 for the first 2013, and then we're also going to have 50% of 2014 and 15, and then we're going to have the balance of 2014. Okay, so what we can do now is actually just formalize our taxable income. And we only have to do 4 years. Okay, so there you go. There's taxable income. Simple as that. So what we have to do now is to determine what our journal entries are going to be for the first year. So let's just go through the calculations, and then you'll be able to figure it out from there. So 2013. Put this in so you can see what I'm working on. Okay, so 2013. First thing we're going to do is calculate taxable income, since that'll be the easiest because we've already figured out what taxable income is. So so we're going to take 67.93 times the tax rate is 42%. So let me move this on a little bit, and I'll do the calculation over here. So it'll be 67.93 times 42%. I'm just going to use 2 decimals because we are doing this in millions. Next, we will, actually I need to put, where are the taxable income? This is income taxes payable. Okay, so we have our taxes payable. So now we need to do our change in deferred tax liability. So the way we're going to do that, the change would be here, because remember, this is our accounting income, and this is what we got from installment sales, so we didn't actually get that. Okay, so we took that out. So that is the change. So we're going to take that 55 and multiply it by the tax rate. Okay, and we'll do that here. Okay, so there is our deferred tax liability for 2013. Okay, so now we want to calculate depreciation. So how we're going to do that, and this is the change in depreciation. So that's the net between makers and our income statement depreciation expense. Okay, so we know we did straight line, so that's here, and then makers is here. So that would also be the change in deferred tax liability. So we have 8125 plus 108.32 times the tax rate. We'll calculate that over here. Okay, let's change this to 2 decimal places. Okay. So now we have our change in deferred tax liability due to depreciation. Now we want to calculate our warranty expense. Now remember, this is not deferred tax liability, this is deferred tax asset. So our change here is going to be here. So we have 50 million times the tax rate, which is going to be 50 times 0.42, and 21 million is our deferred tax asset. Do that. So our 2013 JE is going to look like this. We know that we have our tax expense. We're going to back into our tax expense. Okay? We also know that we have our deferred tax asset, and we can already put that because we know that's 21. Now we have our, scoot this down some so you can see better. Next we have our income tax payable. And we know from the calculation that it's this much here. Okay. And next we have our deferred tax liability. This is going to be twofold because we have deferred tax liability from our income, our installment income, and we also have deferred tax liability from our depreciation. Okay. So now we can back into our tax expense. So just do very easily. Our tax expense is 66.39 million, and if you want to double check that, you can. Debit side is 87.39 million, and the credit side is 87.39 million. Okay, so there's a journal entry for 2013, and I'm hoping that I'm going to slide this down so you can see, because that sort of went off the chart a little bit. So here is the calculation, and here is the journal entry. So we just backed into this amount after we calculated these, and we're going to do every year the exact same way, so that when you come to class tomorrow night, you should have all of your journal entries done, and we can discuss any hang-ups you might have had because of it.